Okay, let's jump right into this explainer. We constantly hear about the transformative power of AI, right? But behind all those sleek algorithms lies a massive, incredibly complex physical and financial reality that is quite literally reshaping global markets. Today, we're going to look right past the hype. We're digging into the true costs, the hidden risks, and the absolute mountain of debt that's fueling this technological revolution. Just let this number sink in for a second. $650 billion. That staggering figure is the projected 2026 capital expenditure by just the major US hyperscalers. To put that kind of money into perspective, that represents roughly 2% of the entire US gross domestic product. 2% spent by just a handful of companies in a single year. It's honestly an extraordinary commitment of resources. Section 1, the trillion-dollar AI boom. To truly grasp the scale of this new industrial expansion, you have to think about it like the tycoons of the 19th century laying down railroad tracks. Today's tech giants are building the invisible infrastructure of the future, and we are looking at a cumulative $2.9 trillion AI data center spend between 2025 and 2028. The US alone is driving more than half of that global growth. Now, the sheer appetite for new capacity here means AI capital expenditures are stretching the absolute limits of what even big tech's massive cash flows can support. By 2026, AI CapEx is expected to consume up to 94% of these companies' operating cash flows. 94%. That leaves virtually zero wiggle room. Which brings us to Section 2, funding the debt frenzy. So naturally, you have to ask, how on earth are these companies actually paying for this massive build-out if their cash flows are practically maxed out? Well, the answer lies in the credit markets. We are witnessing a seismic transition in Silicon Valley right now. For years, the narrative of big tech was all about self-funded expansion, right? Companies generating so much cash they could just fund their own growth. But we're rapidly moving away from those historically cash-funded business models toward a sustained, heavy reliance on external borrowing and capital markets. And the speed of this shift? It's breathtaking. Data center debt has exploded, jumping an astonishing 112% to $25 billion issued in 2025 alone. To fund these giant hyperscale centers packed with incredibly expensive GPUs, companies are pushing deep into complex asset-backed loans and private credit. In many cases, we're even seeing this wild borrow-to-build race, where developers take on massive debt to secure land and power before they even have long-term tenants lined up. AI tech companies have driven an extraordinary surge in the bond markets, too. Public tech investment-grade issuance surpassed $200 billion in 2025. They're pricing these massive, headline-grabbing deals, like Meta's historic $30 billion financing, and they're becoming the absolute dominant supply of new bonds in the global credit markets. Because of this absolute frenzy, AI-related sectors, so that's tech, utilities, data centers, now make up nearly a fifth, 18% of the aggregate corporate bond index. That carries some serious market concentration risk. Investors are chasing the high yields, sure, but analysts are raising real valid concerns about what happens to this interconnected web of debt if AI demand suddenly plateaus, or, if interest rates create unexpected refinancing pressures down the line. All right, Section 3, the depreciation treadmill. Let's pull back the curtain on the actual financial engine here and ask the tough question. Is this debt-fueled spending actually building lasting value, or is it just a mirage? To understand the hidden risk, we have to look at a concept called capital churn. It's basically the reality of running incredibly fast on a very expensive treadmill just to stay in the exact same place. Unlike a railroad track that lasts for 40 years, AI hardware suffers from rapid economic obsolescence. The chips don't break physically, but their ability to earn excess returns fades well before their accounting life ends. Why? Because newer, vastly more efficient chips hit the market every single year. The rental markets prove this exact point perfectly. Think about the per GPU unit economics for an NVIDIA H100. In its first couple of years, the hourly rental rates are sky high, and the profit margins are massive. But because hardware ages economically way faster than it ages physically, rental markets show that by year 4, the hourly rate just collapses. At $1.35 an hour, a GPU's revenue actually falls below its total economic cost. It literally operates at a loss relative to its total cost of capital. So what does this mean for our big picture? Well, it means that if the true economic life of this hardware is only about 3 years, more than half of that headline $650 billion spend we talked about for 2026 isn't actually growing the company's capacities. It's just replacing economically obsolete hardware. That $650 billion acts more like a $400 billion maintenance expense, resulting in only about $215 billion of true net new capital formation. Moving to Section 4, Physical and Supply Bottlenecks. This abstract financial reality we've been talking about is about to slam headfirst into hard physical constraints. I mean, it's really easy to look at a spreadsheet and project infinite software scaling, right? But while innovation determines how fast hardware becomes obsolete, physical power and supply chain realities determine how much hardware can actually be deployed in the real world. You simply cannot compute without electricity and raw materials. We are hitting an energy wall. The International Energy Agency projects AI power demand could jump 50% by 2030. But here's the catch. Upgrading power grids and securing interconnection takes 5 to 7 years. So consider a data center that is completely maxed out on megawatts. Since the grid can't provide more power anytime soon, the only way the company can increase its compute is to rip out older chips and replace them with newer, more power-efficient ones. This hard physical limit just further accelerates that massive capital churn we were just talking about. Furthermore, this entire infrastructure relies on a highly fragile supply chain. To build these advanced chips and the cooling systems they need, we require critical minerals. Over 50% of the world's cobalt comes from the Democratic Republic of Congo. Neodymium magnets are dominated by Chinese supply chains, creating obvious geopolitical vulnerabilities. And lithium, which is absolutely essential for energy storage, requires nearly 500,000 gallons of water per ton to extract. That creates massive, massive supply and resource dependencies. And finally, Section 5, will the gamble pay off? So let's recap. We have an explosion of debt, a treadmill of rapidly depreciating assets, and severe physical bottlenecks. Who actually captures the value in this high-stakes game? We're facing what economists call the productivity J-curve. AI hardware needs to generate its returns in roughly 3 years before it goes obsolete. But for the broader economy to reorganize and achieve measurable productivity gains from AI, that takes much, much longer. Because AI users currently pay less than the full economic cost of the compute they consume, major tech firms are purposely absorbing multi-billion-dollar losses. They're doing this to accelerate adoption, train their models, and frantically defend their competitive moats. This brings up a vital historical lesson. Think back to the 1990s telecom boom. Companies laid millions of miles of fiber optic cable. It was an incredible spending spree that was totally rational for defending market share at the time. But the resulting overcapacity completely destroyed returns at the industry level. AI might absolutely transform our entire economy for the better, but that does not guarantee that the investors financing this $650 billion infrastructure build-out will be the ones who actually capture the financial surplus. As we wrap up this explainer, I want to leave you with a critical question to chew on. We are watching the tech industry attempt to outrun the rapid depreciation of its own historic investments, all fueled by an unprecedented wave of debt. So, are we laying the unshakable foundation for the next industrial revolution, or are we simply inflating a temporary debt bubble that is inevitably bound to burst? It is literally a trillion-dollar question, and the answer is going to define the next decade of technology and